The stock market is a poor representation of what is actually taking place in business. So, within today's presentation, I really want to walk through how companies are operating for us. This is Sean Emery, the Chief Investment Officer at Avory and Company, and over the next 20 to 30 minutes, what I'm going to do is provide somewhat of a concise but share highlights from some of the companies we own, companies we are following, or companies we are really starting to hone on. So with that, let me first state a quick and fun disclosure statement. Avory is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated are not guaranteed, be sure to consult with a financial professional before implementing any strategy discussed. And of course, past performance for these companies is not indicative of any future performance. So as I started this presentation, the markets can be a real poor representation of business operations over the short term. And there's really three cycles that one must be aware of. One is the economy. Much more stable. The band within peaks and valleys are much narrower. On top of that, you have business operations, which fluctuate a little bit more than the economy as a whole. Some companies are growing faster than other companies. Again, you get a narrower band between the peak and trough for the economy, and then the operations can fluctuate slightly more. On top of that is stock prices, and again, much shorter cycles, but again, the stock prices fluctuate much more than the economy or the operations themselves. A good quote, a company can seize extraordinary opportunities only if it is very good at the ordinary operations. This is important as we're always looking and on the lookout for companies which operate at a high level. On top of that, we're always looking for companies with an economic moat, that competitive advantage here at the center that allows our businesses to operate despite the peaks and troughs of economic conditions. So getting on to the companies that really pass some of our tests, economic moats, the industries can vary, as do the growth rates within some of these businesses, as do some of the valuations in some of these businesses. This page, I believe, is a solid reflection of really how we think about investing. So it's really not about the industry or even about the growth rate, but it's truly about these companies and how they're situated nicely within an arena which we have that circle of competence around. So companies like Omnicell, again, within the healthcare medication management space, Square, which again is really empowering these small businesses through a combination of hardware and software. You have companies like Guidewire and Chipotle and Facebook, Wix, which had a interesting product announcement yesterday, which further emphasizes our views on their execution capabilities. The next page really is further emphasizing some of the companies we are tracking. Companies such as Carvana here, which has totally reinvented the car buying experience, led by Ernie Garcia and his team. Not an easy industry to scale. It requires a significant amount of capital to buy inventory of used cars nationally, scale that through single point distribution channels. They like to share their hub and spoke model. But again, regardless of that, Carvana is executed wonderfully in that space. So let's get to the first company. So here's a company we invested in a while back. It's pretty special in my view. Again, not a recommendation, but again, trying to highlight some of the items of the businesses. We'll dig deeper into two companies today and share some thoughts on some others, but that's kind of where we're headed here. So here's the logo of the company I'm referring to. Most of you have seen this logo before. It's pretty basic, but I must add that very few companies can really create a brand where the logo is truly recognizable. Um, this tends to happen in places like fashion and retail, but it's under my view that whenever this happens in other industries, I think it's an extremely powerful attribute. So that's Square, obviously. When most of you think of Square, this is probably what you think about. The business made it extremely easy to operate for small businesses by providing a single hardware solution that's small and allows sellers of goods and services to make a sale at any point in time. So while that's true, that's where they've come from, and that's been phase one of the business, the reader on top of devices. Many people use this today, or use Square today, but have really transitioned to phase two. So for bigger businesses or businesses that started out small and are growing through their platform, what you're seeing is Square develop a suite of products. So these are hardware devices which tend to be commoditized over time, but I think the elegance of the devices speaks volumes. If you look at these devices, I think it's not hard to actually see that they look and feel and have kind of that Apple-esque product feel. No coincidence, though, that Jesse, who's actually leads their hardware division at Square, he was the director of engineering for Apple's iPhone, iPad, the original iPod, and some of the accessories within that business. So phase two has really been moving from a single hardware solution from the phase one to a portfolio of hardware solutions to fit all the needs of businesses, making that sale at any point in time. But really now comes phase three, which is the Square SDK, or the software development kit, which now lets developers of all types use the Square payment software for all use cases. So we're seeing companies like Shake Shack really build out a self-service kiosk using their own hardware, but using Square's payment software within. In addition, Joe and the Juice, which has multiple locations, some here in Miami and some in many other places, again, is using Square's payment software across different devices that aren't Square hardware. This is an important evolution, predominantly because it allows businesses of all types to really use Square in different manners. Originally, Square, right when they started, what we've seen was they really wanted to control the customer experience. So sellers had to use Square. This made every seller go through a similar journey. But this approach has been done at numerous companies where the started with elegant, beautiful, controlled hardware, but it's been that software which has provided the next wave of growth for these businesses. So the giants, Apple, they control the user experience still today from start to finish. People tend to view Apple as kind of that refined solution within this space. Apple's just starting to engage outside of their core hardware and into third-party hardware. We recently got the announcement last week that the Amazon Echo, the device, will now have Apple Music available within it. So again, Apple software, not the entire operating system, but a component of it across a different device. The next one is Tesla, actually, and the company, obviously led by Elon Musk, controls the hardware of this car. That was one of the kind of the missions of the business, similar to SpaceX, his other business. But within Tesla, they have built their own software, and it's really created a hardware to software user experience that has fueled some of the engagement within these vehicles. The last one, and not certainly obvious, is Visa and MasterCard, where most of these two companies were really hardware enabled, meaning they built the infrastructure underneath, but it really took them to grow through hardware and forcing people essentially to limit their cash use and just carry cards. Over time, the cards have been pushed into digital solutions, But since they controlled the hardware and all the cards within individual hands, um, they have a solid footing into the digital space. Side note, obviously Visa actually has an equity stake in Square. Um, when we take that hardware to software thought, the importance of that is Square's a hardware-led company. That's really allowed them to build a brand in which people trust and rely on. The next important aspect of the business is the ecosystem underneath the hardware. So here's really a page from Square's website. It really shows all the things that Square offers to its sellers. So what I wanted to do quickly was break it down. First is banking and kind of human resources services, payroll functions. So Square's using the rich set of data from sellers to offer a range of solutions. They offer instant deposits so sellers can access capital same day. They have loans that they offer based on the data of revenue and traffic. Invoice abilities, gift cards. They recently launched a refresh and new version of their payroll product. So just at this level, Square's building a deeper relationship with their sellers than any other kind of point of sale solution when we go back and think of where they started to where they are today. The next one adds to what I was just talking about and adds to human resources, but human capital management. So this really allows for sellers to have multiple locations with different employee types, track and change permissions for those employees, run analytics on employee performance, who's selling what, where, at which location. So these companies can run and operate their businesses at a higher level, which then fulfills a double mandate, right, where Square benefits as well through payment volume if the companies that are using their products succeed. These human capital management products, there's actually publicly traded companies of decent sizes that focus on this area alone, and Square has successfully made its own niche within its core software. The next is data and analytics, and again, there's companies that are publicly traded doing just this. So speaks to the size and the execution abilities of Square to also add this type of solution within its product suite. So again, this area allows managers to really track and manage the business through a data lens, which is becoming more and more important. The next is marketing. You can build loyalty programs within the terminals. You can track loyal customers, send them coupons to come back, or entice new customers to create that repeat visit. Lastly is the company, and we talked about it before, is shifting its emphasis from internal to more external use case. So they're focusing on engaging with developers. We've seen this approach do wonders for other companies, software-related companies, companies like Twilio, which is a developer-first company and has performed extremely well at the operating side. So all in all, as customers do move deeper into the funnel of using Square's entire ecosystem that we see here, we see a product suite that it builds a moat for Square over time as those businesses expand. So that's is Square from the lens of a company empowering businesses to run. But given that they are a hardware-led moving to a software-led, they've also have been working on building the next phase, which is a peer-to-peer payment solution. So some stats here, as payments moved more online and more global, the peer-to-peer environment has significant long-term value. For example, 2017, there was roughly 63 million people or U.S. adults using peer-to-peer payments here in the U.S., and that number is expected to hit 113 million by 2021. So nearly a third of the population in the U.S. Using kind of these peer-to-peer payment solutions. This is important and critical. Square owns Cash App. It's actually the fastest growing US-based peer-to-peer digital payment kind of ecosystem. Apple just came out with their top apps of 2018 by downloads, and Cash App was number 9. And actually, as of this week, Cash App hit number 1, which is pretty incredible. So Cash App is the number one finance app. It's ahead of PayPal, Venmo, and the likes. This is critical since we see Cash App really being a valuable payment asset for Square at the company level. Um, so all in all, Square is a full solution for all these things, payments and business. Um, and we see them moving deeper into payroll, deeper into payments, deeper into peer-to-peer payments, and we see them moving further along into banking or investments, as they did with Bitcoin trading on the Cash App. And some of the members of the team have voiced their ambitions to become um, the platform for millennials, Gen X, unbanked, and the future kind of banking and payments. On top of that, it's the last segment for Square, but one of the keys is the size of the market. So again, when we step back and we look at companies, there's companies that fill niches and there's companies that are going after massive markets. Massive markets tend to have a lot of competition, but as you can see, they're well positioned with the product suite and the dual kind of angles that they can approach. But again, if you look at how many small businesses there are out there, 21 million in the U.S., roughly 125 million globally. Square is in a good position to capture a decent share of this massive opportunity. Here's the latest quarter. So $298 billion in revenue over the last 12 months. That's 45% year over year, massive growth. That software component that I was referring to, 155% growth over the last year. Payment volume touching 22.5 in the quarter alone, which is almost 30% growth from the year prior. So you think of Square, they're doing about $100 billion in a single year in terms of the payments, the size of the payments going through that platform. Very critical. I guess one thing of note during the quarter was, and I've been pretty vocal about it, is that Square lost Sarah Friar, their CFO, executed tremendously. It's a big loss for Square, but they're looking to fill the void in some capacity. Jack Dorsey remains the founder and CEO. He's also the founder and CEO of Twitter. But again, the company remains healthy at the operating side. And again, they're looking to continue to attack this broad market with a broad suite of solutions. So that's Square. The next one is Electronic Arts that I want to emphasize. So when we look at any business, we really want three things: market growth being one, market share growth being second, their ability to capture market share within that market, and margin growth or some sort of expansion of margins. If we can get all three of those and pay a reasonable price, we think it can be a special investment. So let's start with Electronic Arts, start with the size of the community. If you look 10 years ago, the payment community globally was 200 million players. That's 10 years ago. About 5 years ago, that soared to 1.5 billion players, and today it's roughly 2.6 billion. That number is expected to rise to nearly 3 billion in the coming years. So huge market that they're going after. Some of the future key drivers for this growth is the hardware and distribution of product and games. So looking back, we see 41 years of gaming or games and console types, which has its own compounding effect on players and games, as the individuals who started playing games 40 years ago are likely still within the community. But there's obviously a next wave of gaming, which is things like mobile devices, screen and resolutions becoming clearer, and phones becoming more powerful with augmented reality capabilities, which we know Apple is spending a great deal of effort on, as are some of its competitors. Virtual reality, Facebook owns Oculus, and there's obviously other competitors in the virtual reality space, but it's a whole new element of gaming, which opens up a new range of gamers, players, and hardware within this space. The next one is obviously computers, and as chips and and computers and processing power evolves and improves, the ability to play richer and richer games further emphasizes the different capabilities for the community. There's another interesting thing taking place within gaming, and it's demographics. So starting with the demographics of how many women today are gamers, actually 38% in 2006 women were gamers then. That number is now 45% today. So you're seeing a broader set of gamers, which again, it's opening up a bigger market for some of these console developers and gaming developers as well. Age is another component. 43% of gamers are above 36 years old. So again, when we talked about the consoles over the last 40 years, you see this wide range of ages playing games still. It's no longer just the 25 and younger crowd, but actually it expands further into older and older generations, as they were the early adopters of games when consoles really started to flourish. The last one's streaming. So Electronic Arts, they had a live demo of their cloud-based gaming service. So it's not easy to provide gaming streaming through the cloud, given the nature of the processing required for games to be done in that manner. We've seen Netflix and other related companies that have shifted to the cloud that have benefited tremendously, not only from the quality of the experience, but also economically. It has benefited them. But again, that will open up a whole new community that will potentially become part of the gaming ecosystem. From a market share standpoint, there's a couple different avenues that they can target: geography, genres, and platforms. So as it relates to Electronic Arts, they have 300 million registered players in 200 countries. So very, very well established across the globe, but it will allow them to move into new genres because they already have a footing in a lot of these countries across the globe. Genres being that they're trying to move deeper and deeper into action, RPG, and shooter. We know that they're already extremely popular, successful in areas like sports and racing, with games like Need for Speed, games like Madden and FIFA. So they're really well situated on the far right, but again, it's that far left that they're trying to take advantage of and take market share within that space. In order to do so, it's kind of the next line there where we show studios, and it's important to, if you're trying to provide different genres, it's important to have a good set of studios underneath that have the capabilities of creating these new games. Platforms, so again, as new platforms and hardwares come out, that will open up more and more ways to play games, which again increases markets and allows them to take market share. The last one, margins. So in 2006, this is kind of what buying a game looked like, and to some extent, it's still like that today. In 2019 and 18 and beyond, it looks more like this. This is obviously an Amazon screen, but you are able to buy the digital download of a game and essentially without having to buy the CD that we see on the left. Now, that's important for multiple reasons. So here what you see is total revenue on the left in white. Obviously, it's going up and to the right, and digital versus physical revenue. So digital in blue, that's rising, while physical, the CDs, is declining. On the right, you can see margins, what that means to margins. So again, as they strip out the distribution channels, as they strip out having to create hardware, it is a net positive to overall margins for the business. So there's digital in blue, and then here's margins in white, gross margins in blue approaching 77%, and operating margins approaching 30%. So net benefit to the business as they move into those different areas. So last but not least for Electronic Arts is, who are they? So 300 million gamers. They're one of the top publishers on consoles, top mobile publishers for mobile devices. Here's a set of some of their games, so for your knowledge, things like Battlefront, FIFA, NHL, UFC, Sims, so many different games, both on the consoles, on the mobile. In addition to that, they're extremely popular. You look at their website traffic. This is just for electronicarts.com. So you can see that nearly 60 million, 56 million visits a month hit their site. If you go to their other sites, like Origin, which is kind of their PC gaming website, you can see increased engagement there and visits. So they have a broad suite of websites, and they all see similar trajectory. Um, what's important as well, and another distinction of the quality of their brand, on the top, we're just measuring Instagram followers. So on the top, you see FIFA. That's their game Instagram. Below that is actually the FIFA World Cup Instagram, separate from Electronic Arts. But what we're trying to inspire here is the fact that the game is even more popular in some cases than the real world product itself. So the FIFA World Cup. So what you see here is 17.4 million followers following Electronic Arts Sports FIFA, and 11.7 followers following FIFA World Cup. So that's interesting. How that plays out is that brand power and that ability to distribute shows up with their newest game, Command and Conquer, which is a licensed game for them. But essentially, what we see here is the downloads of the app and where they stand within the App Store. So you could see they launched it about a week ago, and already it's the number 3 strategy game and a top 50 game in the U.S. And top 17 action game. So again, this just shows their brand power. Electronic Arts over the last 12 months has generated $5.2 billion in revenue, gross margins above 70%, trailing operating cash flow of almost $1.5 billion. Again, big player network, 300 million gamers across multiple games, across multiple genres and geographies. So we think they continue to be well positioned. Now I'm going to go just slide by slide, and we'll wrap it up here shortly. But essentially, those were the two games or two companies that we wanted to highlight in slightly deeper levels. And here's just to highlight some of the companies and how they're performing at the high level. So Omnicell, medication management company. Most people have never even heard of it, but something that we followed and eventually invested in. But it's last quarter they did $204 million. They're operating at an extremely high level. Margins have increased quarter over quarter, year over year. They now sit at 48.4%. Trailing cash flow is $60 million. And that continues to grow as well. They closed several deals this quarter, which they saw a record multi-million-dollar commercial agreements, and over 90% of those multi-million-dollar bookings were actually from customers adopting multiple products of the Omnicell platform. So we think that's an important characteristic of the business today. And they also booked deals for the first time in South Korea. And as we sit here today, they have over 40,000 pharmacies of their worldwide customer base. So again, Omnicell performing at a high level. Maybe next quarter we'll go in more detail. Apple, $265 billion in revenue over the last 12 months. It's a really, really big number. $240 billion of cash, 237 to be exact. They sold 217 iPhones last quarter, or not last quarter, but over the last 12 months. It's been around this number for the last 6 quarters. So again, we're still under the camp that iPhones, while we don't expect them to grow at any miraculous rate, we do think that it's more of a staple product within a niche part of the global consumer base. Service revenue is $37 billion over the last 12 months. Big number, growing at a pretty good rate. It's roughly 16 to 18% of revenues over the last several quarters. important part of the future of the business as they move deeper and deeper into their devices. But overall, look, Apple now trades at 9 times their operating cash flow. We think this is very cheap. We don't, again, expect much iPhone unit growth, and they're actually removing units from their earnings calls, which is clearly part of the reasons that investors were spooked. But again, they're building an ecosystem around that phone. They have the watch, which is arguably the best-selling watch of all watches, both smart watches and normal watches. They have the AirPods, the HomePods, and we fully expect them to win big over time. Chipotle, they've generated $1.2 billion last quarter alone. Growth in all different categories, same-store sale growth, quarter over quarter and year over year. They're innovating on all fronts digitally. Roughly 13% or so of their sales come from digital, so people ordering within the app or on the website. So that's an important consideration to have. Each store is now generating $1.95 million on annual revenue on average. So that's an acceleration from 1.7 million a couple years back. So Brian Nickel, who they hired from Taco Bell, has been executing at an extremely high rate, and we're excited to see kind of what he has in store in the future. Here's just an example of our digital dashboards that we have internally. Every single company has one of these, but I guess worth highlighting here so you can see how our visually first approach to analytics helps guide kind of our decisions and allows us to see things a little bit clearer. Blackstone, so arguably the biggest global alternative asset manager, nearly $2 billion last quarter. Their revenues and their numbers tend to fluctuate considerably. But the story about them is they have $456 billion in total assets today. That's grown year over year. That's grown quarter over quarter. Then they also have nearly $100 billion of dry powder. The importance of that is if people are concerned of what's going on necessarily in the global economy and considering that we may be in some sort of late cycle, here's a company that's positioned probably better than most for the next cycle, as they have nearly $100 billion to deploy. So interesting way to think about a company that is highly correlated to asset markets. Therefore, if you think asset prices are vulnerable, you also have the positive effect in which they are well positioned with a lot of dry powder to take advantage. Here's one of the big highlights for probably a lot of people is Facebook. It's been in the headlines almost every 6 minutes on average. Nearly 2.3 billion monthly active users. That's growing still, which is hard to believe. Things like Snapchat and Twitter are falling, and they're much smaller sized platforms. Quarterly revenue 13.7 billion, up both year over year and quarter over quarter. Operating margins 42%. Those have come down quarter over quarter, year over year. We never actually thought that these numbers would stay at those elevated levels as they move deeper into their own product suites like hardware, which tend to have much lower margins. So the company actually recently embarked with a $9 billion buyback. We think that helps them on top of their $15 billion buyback. So combined, that's almost a 10% buyback of the business. But more importantly, you have a company that is in the headlines negatively, but operating at actually an extremely high level. App engagement metrics, which we track, and downloads for the family of apps suggest that this business is healthy. And again, next quarter, this could be a company that we even focus on further. Last but not least, Michael Kors. So Michael Kors is a company that we've obviously had a deep following for recently, last several of years, and they continue to make a transition. One of the things that I guess the story of this quarter and the last several quarters was their social media following. 43 million social media followers across their their brands, and that's a 12% growth rate over the last year. That's important because it's said that nearly 70% of purchase intent comes from things like Instagram. So social media is an important driver of brand awareness, so brand building, but then purchase intent. Gross margins remain extremely high, 61%, some of the best in breed within retail. What they are doing recently is obviously they're changing their name to Capri, which under Capri will then have Jimmy Choo, which they acquired within the last 12 to 18 months, and Versace, which again they recently acquired. What they're trying to do is again create a company focused on social, which you see Jimmy Choo and Versace being two of the most popular social brands out there, as measured by the luxury fashion universe. Um, so it's an interesting strategy to buy these type of brands, ensure that there's a well positioned social interaction there. As a whole, this company trades at 7 times operating cash flow, which is extremely cheap for the product brand. Um, what they're trying to do here, and this is just further color uh, of what's taking place post the acquisition of Versace. Essentially, Michael Kors generates roughly $4.5 billion a year. Jimmy Choo 585 million, and Versace 850 million. Combined, you're looking at a company that's going to generate roughly $6 billion in revenue. And what they're trying to do is grow the lines of Jimmy Choo accessories, move into men's. Versace the same thing, accessories and men's. But most importantly is increase their store counts above what they are today for those two brands. And I'd say arguably the most important from an investor standpoint is diversifying the geographic revenue stream. So on the bottom you can see the Michael Kors all by itself, 69% of revenue came from the Americas. Uh, Following the acquisitions of all of these two companies, on the right you see it'll become much more evenly split, meaning 57% down from 69% in the Americas, and further emphasis within Europe and Asia. So a much more geographic view of consumers, and I think that's important for the brand and any retailer in general, is that diversification amongst revenue. Um, these pages are always companies that we are tracking, following, potentially have invested in. But again, it shows just a little color on who they are. So things like Iteris, who we had a conversation with the CEO last week. In Structure, again, we are that's an education provider, but also moving into corporate learning management systems. Site One is one of the leader in commercial landscaping, similar to like a Home Depot, but actually just strictly commercial. Um, Carvana we talked about, things like Wayfair, Box, Hormel, Stitch Fix, which reported recently, Teladoc. So here's just a couple companies that we're following closely or already have implemented, but big themes, big ideas, and still is under the same umbrella of our train of thought. The last thing, I mean, there's not much left, but essentially that's really it. I want to do essentially say next time we'll share a couple more companies. That's really it for this earnings summary. If you have any further questions, just we can get on a call. If not, just have a good rest of your day, and we'll be in touch. Have a good one.